All right, chapter 21 is a relatively short chapter, about 10 pages. And so I want to talk about three different types of ways you can use incremental analysis in making short-term business decisions, because a lot of times decisions are made on the fly, have to be made with as much information as you can get, maybe not complete information, but hopefully you have enough information to make a good decision. All right. And so here it indicates that product markets can change quickly due to competitor price cuts, changing customer preferences, and or introduction of new products by customers. And so managers have to respond to these changes with these short-term decisions, with a fixed set of resources, unless top management's able to come up with additional resources. Usually, though, you're fixed with what you got, what you've been budgeted for, and you have to react to the changing market prices. We make decisions in business such as the following: special order decisions. Somebody comes in and wants us to make a special order. Should we accept it, or should we use that capacity to do something else? Product mix decisions. Should we make more of product A than B or C, or should we have a different mix? Make or buy decisions. Shall we make a product, or should we just buy it from someone else? And joint product decisions. And so the main problem is sifting through information and determining what information is relevant and what information is irrelevant. Because if it's not relevant, we don't consider it in our decision-making process. And so good judgment about relevant information occurs by looking through the lens of a particular decision under consideration. And so look at this little illustration here. You've got this guy in the middle. He's being bombarded with all this information, financial information, historical, current, and future-oriented. And then there he is in the middle, and down at the bottom, what he's doing is sifting through this information and determining what information is relevant. As you will see, if a cost is a sunk cost, it's not relevant. It's irrelevant. If the cost is an opportunity cost, out-of-pocket cost, whether now or in the future, or if the cost is, if it's an incremental revenue and related cost, it's relevant. Okay, so if you don't quite get that yet, we're going to hit this pretty good. So But just keep that in mind. Sunk costs are not relevant. So what is a sunk cost? Well, it's a cost that doesn't change regardless of your decision. A good example of a sunk cost is a cost that has been incurred in the past. Well, you've already incurred that cost. It's not relevant to your current decision. If the cost doesn't change, then it's an irrelevant cost. And same goes for revenue. If revenue doesn't change as far as your decision is concerned, then it's not relevant to the decision. So it's the incremental or the change in revenues and or costs that are relevant in a decision. So I give this, kind of a lame example, but it's not really a business example, but it's an example nevertheless of this guy who goes to University of Minnesota and wants to go to Miami for spring break. And the big question is, should he drive or fly? And so he kind of in his mind thinks about the costs he's going to incur and determine which costs are relevant and which aren't. Well, if he goes, he's going to have to pay a dog sitter $10 a day. He's going to be gone for, I believe, 8 days. That cost doesn't change, so it's irrelevant. Airfare and taxis versus gas and car insurance to Miami. What is relevant there? Well, let's talk about the car insurance. Car insurance is a cost that's going to have to be paid, or has been paid probably anyway. And so it's not relevant to this decision. And so here, what's different is airfare and taxis versus gas to Miami and back. Well, it's going to cost $200 more in airfare and taxis than it will gas. So that he has to look at that. That's a relevant cost, and he needs to consider the differences there. If he flies, he gets 2 more days in Miami. If he drives, 2 less days. So that might be a consideration, even though it's apparently a non-financial consideration at this point, because nights in motels in his analysis is going to be the same, and meals are going to be the same. So really we get down to this non-financial, well, I get to spend 2 more days in Miami if I fly, but it's going to cost me $200 more. Another non-financial consideration, because you always have to consider the financial considerations, but also there may be non-financial considerations and decisions made. You have to consider wear and tear on the car, the treacherous driving, possibly. This is Minnesota, right? Or part of it is. So he needs to make a decision on that. Is it worth $200 more for me to fly in order to get 2 more days in Miami, or should I just drive? And the decision's up to him. I mean, I can't say which is the correct answer or not. but in business decisions, it's usually a little more cut and dried. Here, not so much. So anyway, information that varies among the possible courses of action must be considered. And so, again, incremental costs and revenues must be considered. Opportunity costs must be considered, even though there's no financial outlay. We'll talk about what an opportunity cost is here in a second. Sunk costs, that's money you already spent. Out-of-pocket costs, that's costs that must, and sunk costs, like I said, is irrelevant to any decision. Out-of-pocket costs are costs that you're going to have to make now or in the future and must be considered before any decision is made. So they have this next example, which is a little more closer to the kind of business decision one might make. And so Red Star Ketchup is closed for a labor strike. During the strike, Red Star is incurring cost of approximately $15,000 per week for utilities, interest, salaries, and salaries of non-striking employees. And so a major film company is offered to rent the ketchup factory for a week at a price of $10,000 to shoot several scenes of a new RoboCop movie. If the factory is rented, Red Star's management estimates that its cleanup costs will amount to nearly $2,000. Solely on the basis of this information, would it be profitable to rent the ketchup factory to the film company? So the $15,000 is a cost that they can't avoid no matter what, strike or rent. And so that cost should not be considered. The costs that should be considered are the incremental revenues and costs of renting out this facility to the production company. And so they have revenue of $10,000 that they could expect from renting out the facility, but they're going to have a cost of $2,000. So the net effect is that if they rent this out to the production company, they're going to have a net gain of $8,000. If they don't, they're not going to have any, right? So it's $0 or $8,000. And so the incremental analysis is the $10,000 minus the $2,000. Well, what's an opportunity cost? You probably didn't think of it in these terms, but your decision to take college courses and if you're looking for a degree, to get a degree, you had to consider opportunity costs. Now, if you're going full time, you probably had to give up a job, possibly, for that. You're saying, okay, I'm foregoing this job I could have if I didn't go to school. Let's say the job pays, I don't know, $20,000 a year. And so if you decide, well, I'm not going to take that job, I'm going to go to school, you're giving up the opportunity cost of making $20,000 a year to go to school. And there, the assumption, at least for most students, is, well, by getting a degree, I hope to make much more money, to be much more marketable. Now, for some students like me, when I went to undergrad, it was a good way to check out for 4 or 5 years, but hopefully you're not like that. And so opportunity costs are not recorded in the accounting records, but are relevant to decisions because they are a real sacrifice. And so opportunity cost is the benefit that could have been attained by pursuing an alternative course of action. Sunk costs versus out-of-pocket costs. All costs incurred in the past that cannot be changed by any decision made now or in the future is a sunk cost, and therefore is not relevant in decisions to be made because they can't be changed regardless of the decision made. So here we have an example. You bought an automobile that cost $10,000 2 years ago. The $10,000 cost is sunk because whether you drive it, park it, trade it, or sell it, you cannot change the $10,000 cost. And so if you're looking to buy a new vehicle, usually you're looking at it when you have an older car and you're looking at some pretty substantial repairs that you're going to have to make now or in the very near future. And so the question is, should I spend a whole lot of course, the $10,000 you paid for it is irrelevant, but the fact that you're going to have to put a lot more money into it, out-of-pocket costs, is relevant. Certainly here in this example, the dealer will trade for $20,000 plus your car. The $10,000 is sunk costs, so it's not relevant, but certainly the $20,000 offer that the dealer made is going to be an out-of-pocket cost to you, either now or in the future. Same goes for repairs. All right, so let's look at some of these decisions. Before I start that, note on page 923 that the cash effects differ among the concepts of opportunity costs, sunk costs, and out-of-pocket costs. Sunk costs represent cash flows that have already occurred. No cash flow effects are associated with opportunity costs until you actually decide which alternative you want to do. And out-of-pocket costs usually refer to planned cash outflows. Okay? All right, so let's talk about some common business decisions that you might be confronted with in day-to-day operation of a business. All right, so first one is special order decisions. And what this is deciding whether or not to accept additional business on top of your regular business. And the analysis should be based on the incremental costs and revenues. And those amounts are those that occur only if the company decides to accept the new special order business. So we have an example here of a company called Par 4. They receive a special order of 500,000 special label golf balls from NGC, a company that sells golf products in Japan. And so their analysis is thus. They have in the left-hand column, under production level, the sales without the special order and the costs. So sales, they sell 800,000 balls at $1.25 per ball for $1 million in regular sales. The cost to make these balls is 20 cents per ball, so 800,000 times 20 cents per ball is 160,000. And then on top of that, they have fixed manufacturing costs per month of $320,000. Now, with the special order ball, they would produce 500,000 more, or 1,300,000 balls. That doesn't change the regular sales number, but if they sell those balls at 50 cents per, that's the offer, they're going to make an additional $250,000 in revenue. Now, if it still costs them $20, or 20 cents per ball to make those additional 500,000, then they're going to have an additional manufacturing cost of 100,000, making it 260,000 total when you include the manufacturing variable costs for producing their regular balls without the special order. And so we have to look at the differences, okay? Regular sales don't change regardless of whether or not we accept this special order, so that is not considered. The special order revenue is considered because it does change. And then under cost, the variable cost, the additional variable cost of producing the special order is what's considered. So the difference between what it would cost them in variable cost to make 800,000 balls less, well, the difference between that and what it costs with the special order is what matters. So that's the difference between 260,000 and 160,000. So the $100,000 difference is what matters. And of course, fixed manufacturing costs don't change regardless of whether or not we accept this special order, so we don't consider that either. So bottom line is, when doing your incremental analysis here, you would come up with the fact that you're making $150,000 more by accepting this special order. Now, remember that you have to consider non-financial issues that might come up from accepting the special order. Now here, I think in the example it says that Par 4's regular orders are here in the U.S. and this special order will be sold in Japan. But, you know, what happens if NGC deceives them and starts selling these products in the U.S. for less than what they're selling to their customers at $125? Well, not only are you going to have some pretty hot under the collar customers, saying, hey, I could buy this from NGC at a lot less than what I'm paying you at $125 per ball. So that may ruin your reputation with your customers. You may lose customers and not even know why. Just some things that you have to consider on the non-financial side. So, incremental analysis is a useful tool for evaluating the effects of expected short-term changes in revenues and costs. And again, managers should always be alert, however, to the long-run implications of their decisions. Sorry, I'm not feeling all that great if you can't tell. Production constraint decisions, also really known as product mix. Managers often face the problem of deciding how scarce resources are going to be utilized. Usually, fixed costs are not affected by this particular decision, so management can focus on maximizing total contribution margin. And so, in their example, we have this art studio or something like that that creates 3 products: watercolor paintings, oil paintings, and custom frames. Total output, however, is limited to what can be produced in 6,000 hours of direct labor. So they have what you can assume from that is, or deduct from that, is that they have a small labor pool, really can't grow it. The contribution margin per direct labor hour required to complete each of the studio's product is shown as watercolor paintings. Okay, so you got your unit selling price minus unit variable costs to come up with the unit contribution margin. And what they do is they divide the unit contribution margin into the direct labor hours required per unit, because what's relevant to their decision is what is the highest contribution margin per hour for each product. And within certain constraints, what they should do is pick the product that has the highest contribution margin per hour. In this case, the highest contribution margin per hour comes from the product watercolor paintings. So in a perfect world, they should want to make more watercolor paintings than they do oil paintings and or custom frames. The problem with that, though, is that if they just sell that one product, it may not be sufficient to allow France Studio to sell all of the watercolor paintings it's capable of producing, depending upon the demand. And the same goes for frames. I mean, I don't have a lot of experience in this, but I can tell you that some people consider the frame just as much as they do the painting. And so if this company was just to make watercolors and not make any frames, they might actually lose customers. And so you have to consider these complementary products such as frames that contribute to the sales of their other products. Make or buy decisions. Should I make a certain component of a finished product, or should I simply buy it from someone who manufactures it? And so you have to compare the purchase price of buying it versus the additional cost to manufacture the part. Another consideration is, what would you do if you decide to buy this part? What are you going to do with that now idle manufacturing capacity? So there might be an opportunity cost there to, if you stop producing this component, you could use that now excess manufacturing facility to make something else. Or possibly rent it out or something. Okay, so the cost to produce an item must include the direct materials, the direct labor, and the incremental overhead. And so this predetermined overhead rate that we've been talking about considerably is not a part of our decision making. It's only the incremental overhead that's considered. And so Excel makes computer chips used in one of its products. Unit costs based on the production of 20,000 chips per year are the following. And so which costs here are relevant? Well, certainly the direct labor to make each unit is relevant, as is the direct labor and the incremental cost of overhead, which is the variable overhead. The fixed overhead is irrelevant because that's going to have to be paid regardless of whether or not they make or buy the product. So that is an irrelevant cost. So what we have here is $15 of unit costs that are relevant, 13 which are irrelevant. And so an outside supplier is offered to provide the 20,000 chips at a cost of $25 per chip. Fixed overhead costs will not be avoided if the chips are purchased. So, like I said, Excel has no alternative use for the facilities. Should Excel accept the offer? Well, so it's going to cost them $25 per chip, and the relevant cost of making each chip is $15. So the answer is they should not accept the offer to buy the chip. They should continue to make it because the cost of making it, $15, is less than the cost to buy from some outsider. So they add some new information. What if they can take that additional capacity, if they buy the component, they can take that additional warehouse capacity and rent it out to another company for $250,000 per year. Should they buy or the chips and lease the facilities? All right, so $250,000 is certainly relevant. That's incremental revenue to them. What is the incremental cost to them if they buy? Well, it's going to be the difference in buying 20,000 units at 25 versus making those units at 15. So there they are losing $200,000 in the deal, but yet because their revenues of $250,000 exceed the additional cost of buying, the answer is they should buy the chips and lease the facilities because it's a net increase of $50,000. And so the opportunity cost of the facilities, renting the facilities, changes the decision. One other type of decision I want to talk about is sell, scrap, or rebuild decisions. And so here what you have is a product that you manufactured that for some reason or another is not up to standard and therefore cannot be sold as is, at least not in your regular market, not at the regular price you would normally sell it. And so the main thing to consider here is that the costs incurred in manufacturing the units of products that don't meet quality standards are sunk costs and can't be recovered. Therefore, it's irrelevant to your sell, scrap, or rebuild decision. And so in determining whether or not to rebuild the inferior product and make it marketable, you have to consider that as long as the rebuild costs are recovered through the sale of the product and rebuilding does not interfere with normal production, you should always rebuild. And so they have this example of a company that sells makes and sells laptop computers, and they have 500 computers that are obsolete, and it costs them $325,000 to produce those 500 computers. That $325 to produce those 500 laptops is irrelevant to any decision on whether or not we should sell, scrap, or rebuild because it's a sunk cost. Now, what options they have are to sell to a company called TSN, Television Shopping Network, for $250,000. So no incremental cost from that, it's just all incremental revenue. Another option is to sell to a school district or districts for $235,000. So certainly between those two options, not giving any consideration to non-financial matters, they should sell to TSN, right? And then last but not least, they have an option to rebuild the obsolete laptops and turn around and sell them for $450,000, and it's going to cost them $190,000 in incremental cost to rebuild these laptops. And so the incremental income from the rebuild is $260,000 And so assuming that they have sufficient capacity to rebuild without interfering with their normal production, at least among these three decisions, they should rebuild and turn around and sell because it creates the most incremental income. Now, some non-financial considerations might be, well, what about the PR we would get from selling these to a school for a much discounted price? But the big problem there is, well, we're selling them an obsolete product. What is that going to do to our reputation? Because one of these days, these school kids are going to be consumers, if not already, and if they're using obsolete equipment, how is that going to make them think about our product in the future? So, again, you have to consider financial and non-financial considerations in making these decisions. And really, really don't want to talk about joint product decisions. So that's really all we're going to talk about in this chapter. So I will be doing a couple of problems as examples here in the next day or so.